to call him the Steve Jobs of investing. As you may have guessed, he's the one and only Ray Dalio, and it's my great pleasure to welcome him on the show today. Ray, welcome to the show, and thank you very much for taking time out for your many admirers in India.
Well, thank you for having me. I look forward to our interesting conversation.
Well, the epithet of Steve Jobs of investing, I mean, does that annoy you or do you take it as a compliment?
No, I was an admirer of his. He was an independent thinker who came up with great different ways of doing things that contributed a lot to what our world is like today. Wow, to be compared to Steve Jobs is an honor that I really don't deserve, but I'm happy to get.
No, you do deserve it. You're being too modest. But let me start from the top, Ray, because the last few days, all the chatter in global financial markets has been about what the Fed Reserve Governor told us a few days ago. Was he signaling that rates will not go up a lot, they're almost done? Or would rates go up significantly higher to tame inflation? But it all boils down to the genesis of the problem, as you've been articulating in recent months, which is the sheer amount of debt and liquidity which has been pumped into the global system. Do you think the US Federal Reserve and central banks across the world can dial back the excesses that they've made over the last 10 years?
We first start off with what is the level that the inflation rate will settle at? Then how much higher do bond yields have to be? And then what will short rates be relative to those? So just to give you the quick answer, I think, we're going to have an inflation rate that is probably in the vicinity of 5%-ish. But it's a very uncertain inflation rate because of all the shocks that we have around it. But let's say 4.5%, 5% is probably what it settles down at after this tightening. The real rate, in other words, the rate above inflation that the interest rate is now at, is in the vicinity of 1.5%, a little bit higher than that. So that would mean that there would be probably approaching a 6% risk-free rate, and the Federal Reserve will put the short-term rate up toward that level. That level of interest rate is very harmful, very damaging to the economy, but what the Federal Reserve is trying to do is balance those, having an interest rate that's high enough for the creditor, but not so high for the debtor. And so I think what you're going to see is a slowing of the pace of the rise, but an approaching, let's say, over 5%, probably in the vicinity of 5.5%. And that'll have an effect on all markets. It'll have a negative effect on stocks, right, because it has, of course, as interest rates go up, they compete, and then there are the challenges. And of course, that interest rate is the government rate. If you have low-grade credit, you can add 5 percentage points to that. So you're talking about a 10, 11%, which will have a very severe negative effect, particularly on companies that have relied on receiving funding on an ongoing basis. In other words, they don't have enough profits to carry themselves.
Right. So, Ray, just to pick on the last bit of what you said, if short rates indeed approach 5.5 to 6%, is that baked into stock prices already? Has the market factored it in fully, you would say? Or do you think prices need to adjust in the months to come to that kind of scenario?
No, it's not priced in. What's priced in the markets is that there will be a sharp fall in inflation rates. We do know that there will be a fall in inflation rates as some of the exogenous factors like the oil price won't stay up at where it is, and such things, some commodity prices. We're seeing that already. We're seeing that in housing prices and so on. So that'll bring it down some, but that brings it down from numbers that are in the vicinity of 8% to something that's lower than that and not sustaining. The wage sector, the employment sector, is going along relatively well because unemployment rate is low, so there's still demand, and the inflation that we're seeing is also coming from compensation inflation. So we're going to see uh, those rates have to rise. So you see that built into the curve is a fall off in rates and a fall off of inflation. And I believe that you'll see it staying higher than those levels that are built into the rate. And of course,
For how long though, Ray? Because, when you talk to some participants in the market, they seem to suggest that inflation, as you correctly pointed out, levels out in 2023. But the pessimists are talking about a 1970s-like situation where inflation surprises us and lingers on at a very high level for many years. What are the risks of that?
There's so many demands on money. But we need money for poverty alleviation, building infrastructure, repairing the Ukraine, spending money for climate change. No longer do we have a mentality like an individual might have. They might say, how much money do we have and what should we spend it on? The big difference between individuals and governments is the governments don't have that constraint because they can print money. So I think we have this trade-off. Whenever in history you have a lot of debt and a lot of financial assets, it becomes very, very difficult for those to be balanced. And we're now in a shift. The prior decade, we had falling interest rates, which were goods for holders of bonds. Cash was very cheap, free almost. And so the whole investment landscape was very much built around that. Now we're having this adjustment away from that. So central banks try to balance growth and inflation. And so it will be a difficult balance, which creates an environment of stagflation, I'm afraid.
Now, the question for any investor, of course, is that how do you preserve or at least conserve your wealth at a time like this, which is fraught with so much uncertainty, as you just outlined? I mean, Bridgewater has done a remarkable job over the last year or last couple of years, especially in preserving and growing capital at a time when the indices have fallen very sharply. You're famous for saying cash is trash for most of your investing career. Would you say that even today, or do you think that the turf has changed?
Over the long run, look at your returns relative to inflation. Whichever country you're in, whichever currency you're denominated in, look at the returns relative to inflation. Too many people look at just the level of returns and they don't pay enough attention to inflation. Generally, stay away from debt-denominated assets. Third, have a well-diversified portfolio. Diversification reduces risk without reducing expected returns if you do it well. Also, don't be too tactical. I think you have to realize that the markets are a zero-sum game. To compete in the markets is more difficult than competing in the Olympics because there are more people trying to do it and taking money away from others. So have a strategy which is over a long period of time, to save money in a diversified portfolio of assets. So those would be the most important things, I think. I look at the differences between countries.
Ray, I want to touch upon the third point that you mentioned, if you will allow me, because that's a very important point. The power axis, the changing political power axis that you alluded to between US and China. But, we've lived 75 years without any kind of major war globally. Do you think that era is about to change? Because you've spoken very ominously of late about a period of 1930 to 1945, which you think the world is veering back to.
Yes. In my book, which is an extension of a study that I did, I needed to go back in history and follow and examine what happened when conditions were similar to today. And so you will see in that book, it's called The Changing World Order. You will see in that book, and by the way, there's a video called the YouTube video called The Changing World Order. It's free and it's entertaining and it's informative. You'll see in that measures that go back 500 years, and you will see cycles. Cycles are just, it's nothing predestined by a cycle other than their mechanical cause-effect linkages. And so if we look at the financial issues we just talked about, size of the wealth gap, printing of money and all, if you look at the internal conflicts and use measures, size of the wealth gap, size of political gaps, amount of populism and the like, and if you look at the external factors, the conflicts between countries, the military buildup and such, they are all, each one of those, the highest levels since the 1930 to 45 period. And you go back over periods of time, and they all interrelate to make less peaceful periods, periods of greater conflict. And that's a period that we're in. And so when we look at that, you can see the geopolitical. You know, in India, it's right. Well, all big countries and many little countries are in the middle of that. So what we're seeing is no longer the minor country confrontations, something like the United States and Afghanistan or Iraq. It is now Russia and China. And there are 5 kinds of wars. There is a trade war, a technology war, a geopolitical influence war, a capital and economic war, and a military war, 5 of those. We are in the first 4 of those. If we never go to a military war, we are still having damage happening because we are still in an environment where globalization as we know it is declining. Because right now, in fears of those wars, there is the desire for self-sufficiency. It used to be that the world would come close to producing items and trading items wherever it was most efficient. That is now changing. Now it's wherever it's most secure. So you're seeing that change in global economics happen in an important way, resulting from these geopolitical changes. And we could find ourselves in a military war. I'm not saying that that's inevitable. I'm saying, though, that right now, there is not a United Nations or world court that resolves disputes. They're resolved in terms of these types of fighting. So, yes, it's very much an influence. And those influences then affect countries differently. Those that are in wars of those types have more problems than those that are out. Neutrality is important. The 3 things that I look at when I'm looking at countries is first, the financial. Do they earn more than they are spending financially? Do they have a good income statement and good balance sheet? Second, do people within the country operate in a harmonious, effective way, healthy competition, but not destructive political dysfunctional behavior? And number 3, are they at risk of an international war, or are they more neutral and staying out of the international war? If they are those 3, financially sound, operating well with each other, and operating in a way where there's minimal risk of being directly involved and they're more neutral, I favor those countries.
And using those 3 parameters, how would you compare China versus India today?
I think India has a great potential. India I use indicators. We use indicators of the next 10 years growth rate. Some of the indicators are the cost of an educated person. In other words, what is the education level, but also how expensive are they? Barriers to trade and capital flows, levels of corruption, many different indicators. And on balance, India should have the highest growth rate of any country. And it's opening up to the global capital markets. If that continues, that'll be efficient for the capital markets in India and capital flows. And it is largely taking a neutral position in these conflicts. It, of course, needs to develop a very strong leading economy related to technology. It is not the two main competitors in technology development. Big technology platforms and all of that are still, of course, the United States and China. And those are going to be cutting edge areas. But its level of indebtedness, a number of indicators indicates that it should do very well over the next 10 years. But it'll be important to have a modernization, particularly of the capital markets, to bring in the efficiencies. So it's at an earlier stage of development, but should be a very good environment as long as those are handled well.
At this point, a quick break on the show, but we shall return with Ray Dalio of Bridgewater, the founder and manager of the largest hedge fund in the world.
Fashion industry is all about new designs, styles and creations. Well, now fashion designers have a new playground for their creations, the metaverse. This digital world where, thanks to an avatar that gives us a virtual twin, we can evolve and act just as we would in the real world. We enter it through wearing a virtual reality headgear or by watching a computer or smartphone screen. The metaverse is a space for experimentation and testing out new products, allowing designers to push the boundaries of their creativity. This has economic advantages too. By testing out their collection in the metaverse, they can then analyze public reaction in it and adapt demand accordingly to avoid surplus production and unsold items in the real world. In other words, an eco-friendly approach. For other designers, their creations will stay digital. On specialized platform, brands commercialize their virtual clothes by attaching to them an NFT or a non-interchangeable unit of data stored on a blockchain that can be sold and traded using cryptocurrency. This kind of marketing saves brands from their worst nightmare: fakes flooding the marketplace. With the second-hand market booming, reselling a pair of virtual shoes associated with an NFT will give the designer royalties on each transaction. Some brands link a virtual fashion item with its counterpart in reality.
Welcome back. You're watching the Business Today show. I've been in a scintillating conversation with Ray Dalio of Bridgewater, who the Time magazine calls one of the 100 most influential people in the world. Now, we've been speaking about, Ray, through this conversation about how the next 10 years could be so different from the last 10 years in pretty much every aspect, whether in terms of money creation or economic conditions. But, that leads me to a question on how technology in terms of an investing as a class would do over the next 10 years, because a lot of people seem to believe that the real bull market in the NASDAQ is over now. I mean, the next 10 years will not belong to the NASDAQ as the previous decade did. And stocks like Facebook, etc., down 50-60% from their peaks. Do you agree with that assertion that the technology part of the American market might have seen its best?
It's important to distinguish the price of a stock and its up and down movement versus its prospects. So there was a bubble in tech stocks. Mostly what's happening is that a number of these have negative cash flows. That means they didn't have earnings that will support those prices. And in many cases, they didn't have earnings. And they relied on either borrowing money to make up the gap or raising venture capital or private equity money. And free money was basically, free and plentiful money was basically the paradigm. And so you're now seeing those companies who have negative cash flows be severely hurt, because if the money doesn't come in, then they'll go broke. They'll run out of money. They have to contract and so on. And we're seeing that happen. So that's different than the fact that we are at a point where it is the bright spot of inventiveness. So our society will see it. Depending on where investors buy, they may not see it. But you're in an environment now where inventiveness is greater than it has ever been in history, because technologies have helped thinking. We have technologies that can supplement our thinking abilities. And we also have a venture capital market that means that it is easy, not as easy as it was just recently, but it is still relatively easy for those who have good ideas before they're prepared to be public companies, to be able to get capital, to be able to test out those ideas before they're brought public. We have a political election now in the United States, midterm. I think that also we have an economic cycle. I think both are going to get worse in the United States and elsewhere. So you're going to have more internal conflict, and you're going to have, at the same time, more economic problems as we have stagflation. And that'll take us into in the United States, the 2024 election. Similar patterns are happening around the world. I think that's going to be very difficult. It's also going to have a difficulty because the international conflicts are not going to improve substantially. So I think that as we go into the 2024 period, you're going to encounter more of those problems. At the same time, I think probably there's the cost, not just the effects of climate. Climate remediation is estimated to cost $9 trillion a year in order to reach goals which probably won't be reached. And who's going to pay for that money? That's very expensive at this time. So I think between now and 2024, it'll become an increasingly difficult period, but there'll be good inventions and there'll be good developments. So I think that if I was to pick a period of time that I think will be particularly challenging, it'll be in the vicinity of 24, 25, perhaps. But inventions go on and improvement. So
on
the
that
main
sobering
thing
note,
is that we don't get into a war. In other words, if this just becomes an evolutionary struggle, we'll get through this. Even in depressions, most people can't remain employed. Even in wars, most people don't get killed. In other words, it's a difficulty, and individuals who are smart can navigate such things. We'll get through it. It takes a while, but we'll get through it. The main thing is, avoiding the wars.
Fingers crossed on that, Ray. I hope we do. But on that sobering note, I will have to thank you because we're out of town completely on the show. But it's been a real pleasure talking to you, and thank you very much once again for taking time out for us.
Thank you. And I think if we think that peace and prosperity are possible, and it really mostly depends on how we are with each other, I think that that's a beacon that we can look at the choice and hopefully handle it well. So thank you for your time. Thank you for allowing me to pass along this message.
Our great pleasure. Thank you.